Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, when it comes to investing in mutual funds, one is often told to start early in life. After all, the sooner you start, the more time you give your wealth to compound over the years. But what about senior citizens? How can they start their journey in mutual funds? Let's understand all of this with Arun Kumar, Head of Research, fundsindia.com. Arun, good evening and welcome to the show. We usually talk about millennials and Gen Zs give them a roadmap of how they should start their investment. But what about senior citizens entering the equity space via mutual funds? Too risky for them because we've seen times changing though.
Yeah, hi Kavita. Thank you so much for having me on the show. So, broadly, if I take a step back and look at what are the major three concerns for any person who is retired, one, it starts with the fundamental thing that this is probably the last large amount that they have, and their incremental salary inflows are no more there. So, in that sense, safety becomes the highest priority. So, the first thumb rule that most of them have is that better safe than sorry. So, there is naturally an inclination towards products which are extremely safe, and they are slightly willing to compromise on the return. So, the primary starting point is the safety aspect. But then again, the second part is that you are also taking the money out of your portfolio every year, and then again you also have this inflation increasing the yearly requirements for you. So net psychologically there is also fear creeping in every time you start taking the money out of your portfolio, and if your returns are not accommodating for both the inflation and the fact that you are taking money out of your portfolio. So that is also the second aspect which kind of has to be combined along with the first part, that I need it to be reasonably safe, but at the same time, I can't overdo it because I need my money to grow in such a level that I can adjust for inflation, and also the fact that I am going to take out money almost every year for my own needs, right? And the third part is it also has to be fairly easy to take out the money any point in time, be it some medical emergency, or you don't want it to be an asset class like say land, where it is reasonably difficult to sell and get the money back. So overall, these are the three major trade-offs which any retired investor will have to take. So in that sense, if you really look at it, mutual funds are a good space which can provide a decent solution for all these three problems. And so equities can definitely be a part of the overall solution, where it will predominantly cater to the fact that the returns will be definitely far better than inflation over the long run. It is super liquid, but again, on the safety part, the near term might be a lot more volatile, and they will have to go through temporary falls on a regular basis. But again, the idea is to combine it with far safer debt mutual funds and probably a little bit of gold, so that overall you can combine and build a solution which is fairly addressing all the three, and you take a trade-off which you are kind of okay with. So I think broadly that's the space where mutual funds are getting more attractive for retired folks. And again, equities are not the entire thing, but as a part of their overall solution, it makes a lot of sense.
But then, just to get a perspective, Arun, the trade-offs or the concern that you just highlighted, if I want to compare with traditional form of investment instruments that usually, someone at 60 or maybe retiring would want to consider, what are the red flags? I mean, you've highlighted the trade-offs beautifully over here, which makes it very comfortable, although it has to be a certain part of your portfolio planning. But then if I want to compare these concerns or these trade-offs with the other traditional or more comfortable investment avenues, what would those be?
Yeah, so traditionally, if you look at it, most often than not, you will find people going for FDs as their primary starting point. And then there'll also be some insurance products which kind of guarantee you cash flows after, say, 5 years, or there might be annuity plans which start immediately. But broadly, in these two, you are more or less guaranteed your returns. But again, the trade-off is that the returns are also very, very low, that they are probably just about beating inflation, or in some cases they might be slightly lesser than inflation also. So this is a challenge which most of them kind of realize maybe 5 years down the line or 10 years down the line. So this is predominantly, and Probably the other sources, like you have your own home and you get rental income. But again, in India, rental income yields are extremely low. They are around 2-3%. So again, that is also not a great thing. And land or real estate is, again, if you're buying it purely for the appreciation, there's this problem that you can't take out the money anytime, and it requires a lot more due diligence and activity from your side. So net putting all these together, that's the so if you're looking at all these products, the first thing to look at would be like, do you really understand what this product is and where are the returns coming from? Sometimes what happens is we don't ask the basic question saying, how are these returns coming, and are the returns at a basic level that they are able to beat inflation? So first level, where is the return coming from? Do I really understand the product? And is the return at least bare minimal beating my inflation? The higher is the better. But again, I can't put everything into very high return products. The second question would be that, are there hidden charges? And what is the lock-in period for these kind of products? Usually, you will find that there are a lot of hidden charges in most of these products. And sometimes the lock-in periods are also extremely long, say 10 years or 7 years. So these two are, again, very critical in order to look at it. And the most important part is to also understand the different kind of risks that the underlying product is taking. It might be into pure debt like products, or it might be into equity. But the point is that the underlying is usually not very clear. So you need to really go inside and then check where is my money getting invested, and based on that, kind of take a call on what is the underlying risk. Now, once you put all these three things together, most of the red flags you'll get to know most of the red flags. And if the returns are insanely high and it looks too good to be true, then you always need to be much more careful. If somebody says guaranteed, but the returns are insanely high compared to an FD, then you need to be really, really careful, because it means that there's a lot of risk involved. So overall, putting it together, understand where the returns are coming from, and are your reasonable return expectations, can it beat inflation by a decent margin? And the second level would be, what are the risks involved? And the three is that, what are there hidden charges, and are there any kind of lock-ins, or how easy is it to take my money back if required? So I think if these three are broadly checked, I think you should be good to go.
Arun, 60 cannot be the age when you want to start out in equity through mutual funds, or you think that's doable?
See, I think, generally we have seen that people who have already got an experience with equities, probably in their 40s or 50s, are a lot more comfortable when it comes to building slightly equity. I mean, they're obviously not going to be very heavy on equities, but at least most of them will kind of at least have a 40 to 60% equity kind of an So they're comfortable with equity exposure. But for somebody starting out equities for the first time in their 60s, I think most of them are kind of taking an approach of testing waters, where they just want to try, because they kind of realize that, hey, there is a problem in terms of I'm not able to generate decent returns which can help me beat inflation, because I can't have everything in fixed income kind of product. So I need one product which can give me that kicker. But again, the caveat is that it is very, very volatile. The ups and downs, the ups are easy, but the regular downs are a little more difficult. So we have seen that people who are new are mostly testing waters with very small amounts. And then eventually, as they build confidence, they kind of build it over a period of 5 years. But my sense is, though you are retired, you will at least bare minimal need anything around 40% to 60% in equities, so that you can build a reasonably good solution which can account for inflation, and also address the fact that you are going to take money out of that. But again, if you have a very, very large amount of money, then this equity allocation you can completely do away with it. But I'm assuming somebody at 25 times or 30 times the yearly requirement that they need, if that's your portfolio that you're talking about, then I think it makes a lot of sense to at least have a bare minimal 40% into equity. Otherwise, like otherwise the compromise has to come in the form of lower spending that you do. So net, it's all the trade-off. But my sense is, if you have a comfortable 25 times your annual requirement, then I think 40 to 60% equity is a good enough number to start building your portfolio.
To start building your portfolio even at the age of 60. But then let's understand the entire process of SWP now, which is a fantastic feature that mutual fund actually allows. So if someone has a good amount of corpus that they've counted in and planned really well, but then invested in traditional investment instruments, and at the age of 60 want to take a route of SWP through equity mutual funds, how can they do it? What should be the homework?
Right. So the way we kind of approach this problem is fairly break it down into simple parts. The starting point would be that you at least have, say, 25 times to 30 times of your annual, let's say you need X as your entire yearly requirement, at least have 25 to 30 so that you can start building a decent portfolio. The higher the better, but bare minimal 25 should be a good enough starting point. Then the second question would be that how much do you want in equity and how much do you want in debt? The logic being very simple. The more you have in equity, the better will be your long-term returns. But again, your ups and downs that you will see over a 1 year, 2 year time frame will be far, far higher. So I think bare minimal 40, 50, 60 is a good range to start with. So the second point would be figure out what is your split between equity and debt. If required, you can also add 10 to 20% into gold, but let's keep it simple, equity and debt. So maybe say 50% equity, 50% debt. And then the third level would be fill your equity buckets using either passive or you can use active funds. And then debt, again, you keep it extremely safe. You keep it to very low duration products and super high credit quality funds. So mostly stick to the categories like short-term funds or low duration funds. So once you put this together, you let it run for 1 year. And after 1 year, you take out the yearly requirement that you need and you put it into a liquid fund and make sure that an SWP starts from the liquid fund. So net, what happens is every year end, you take out the money. And the key question is, in what proportion should I take? Should I take more from equity or should I take more from debt? This is where the beauty of rebalancing comes, because you've already started with 50% equity and 50% debt. Just take out the money in such a format that your 50-50 ratio kind of more or less remains the same. So which means what happens is that every time equity markets are doing extremely well, automatically you end up taking more money from equity and lesser money from debt. And let's say equity markets have fallen by say 15%, 20%, then you end up not touching your equity, but you end up taking more money from your debt side. So overall, and then you put it on into your liquid fund, and then from there, anyway, there is an SWP which is automatically set. So broadly, if you look at it, you will hardly need to spend say 1 to 2 hours. And once you get the fund selection right, it's mostly a once in a year activity. So broadly, the starting point to build it might take a little more time, but once you build it, it is just once a year activity and everything else can be automated. And as a good practice, you can always have 2 to 3 years of your money requirement in an emergency fund, mostly in a very, very safe liquid fund, or you can also keep it in your bank FDs. But this can be a good practice. So overall, once you put this together and combine it with an SWP in that liquid fund, then I think the solution can work well. But for some people who want to keep it really simple, you can directly look at products like balanced advantage funds or hybrid funds, and then directly set up an SWP out of these funds, which is a little more simpler. But again, the small nuance is that sometimes even when the market falls, you might be forced to take a lot more money from equities because you don't have control over where you're taking the money from. You're only taking it at an aggregate level. But again, this is a fairly simple solution. But if you want to make it a little more nuanced and you want to have a little more control, the first approach can work. But again, as I told, once you combine it with SWP, it's more or less like an automated solution for you with maybe 1-2 hours of work, probably every year when you rebalance.
Last question, because we're talking about senior citizens or retirees, we cannot miss the pension plans offered by insurance companies. No way we can compare it with equity, but then there is a lot of trust in insurance-based investment products. Your comments on it?
Yeah, see, again, it's a fairly simple concept that anything that is guaranteed through these annuity plans, it is very, very comfortable for most investors. But again, because the risk is minimized there, you will also find that the returns that you can generate from that is not significantly over and above inflation. Mostly it will be slightly above inflation, or in fact in line with inflation. So the key point would be that anything that is really extremely safe and more or less kind of you are reasonably sure what is the return that you get, this will generally be on the fixed income side, or let's say these annuity products. And the compromise that you take for the safety is on the return front. So my suggestion would be that while you can have one part of it which will give you that safety angle and the emotional comfort, you will definitely need to have some bit of equities, because otherwise to outperform or to negate for the effect of inflation, and for the fact that you are also going to take money from your portfolio and you don't have inflows. So I think equities are one of the best asset classes which can negate for this. But again, the caveat is that every year mentally you should be prepared that there will be a 10-20% fall in your equity portion. It's like last 42-43 years you've seen that every year there's a 10-20% fall, and once every 7-10 years there's almost like a 30-40-50% fall. So this is like what you've seen from history. So at least this should be a part of your base expectation. Now for this, to compensate for this, you have the safer the annuity products, or the FDs on the other end, or probably debt mutual funds on the other end. So the idea is to combine both of these, which will ensure that you are able to handle the volatility of equity and get the long-term returns, and at the same time have safety of the fixed income, but you are okay with that return compromise you take on this. So it's a trade-off that you finally take.
All right, so that's a lot discussed about senior citizen entering equity at the age of 60 or even post-retirement. Thank you so much, Arun, for being on the show and helping our viewers understand this today. Thanks. On that note, we'll take a quick break, but then post that, let's get your financial portfolio queries answered by Anil Reko after this break.